Welcome back to the channel. My name is Brad, and today we're going to talk about CLOZ from Panagram. I think I'm going to call it Panagram. P-A-N-A-G-R-A-M. Panagram. Maybe they don't pronounce that second A, but I am. I'm just going to go with it. So this fund invests in the BBB and the BB debt tranche. So the conversation is what are we talking about with these debt tranches? So let's take a quick review again. So the debt tranche consists of the triple A's, the double A's, the single A, the BBBs, and the double Bs. And they're made up of senior secured loans. And that is very interesting because there's a recovery rate on senior secured loans higher than the bonds. So these fall right in that middle range. Some might call it the mezzanine level. But one question that came up was, how will these do as interest rates fall? So these are floating rate loans. So they're going to pay a certain amount of percentage above SOFR, S-O-F-R. That's Secured Overnight Financing Rate. It's a floating. Every 90 days, that rate's going to change. So will the loan rates change. But they're going to be paying that spread. So on a triple B, they're going to pay about 5%. And on a double B, they're going to pay about 8.5% above SOFR. So as SOFR goes down, it's actually better for those companies to be able to make the profits. This is why everybody thinks the Russell is going to go up, because these are the same companies that are in the Russell. They're about Russell 3000 maybe. And what happens is as interest rates come down, SOFR will come down. And then when SOFR comes down, that makes these companies more profitable, so they'll be able to pay those loans back. And that's important to all of us, especially if we're into this. So the conversation always has to be, what's the default rate on triple Bs and double Bs? Well, I went out and found a little bit of information from some company, I don't know, Standard & Poor's. Who's the Standard & Poor's data? Who comes up with this kind of stuff? Well, somebody did. And on CLO 2.0, which started a few years ago, let's talk about the default rate. Oh, wait a second. 0 on triple Bs and only 0.4 on double Bs for the CLO 2.0. Very interesting information, because that tells me that they're going to be pretty profitable because nobody's defaulting, especially when interest rates are falling. That's going to make it easier for them to be able to make the payments. As I said last time, my daughter says I'm cray-cray. Who invests in this stuff? And I kind of went off and said, hey, banks do. Oh, do they? Well, banks own about 35%, according to the latest data from Bank of America, and Japanese banks own about 19%. Insurance companies owns about 17%, and hedge funds owns about 28%. So you sit back and go, and that's in the triple A debt tranche. So in the BBs, it's insurance company and asset managers and hedge funds. Again, this is from Bank of America, just kind of giving us who's investing in this. So this is how insurance companies and hedge funds and asset managers are making money with your money overnight, and you're just sitting there wondering what you're doing. Like, really, why am I doing this? So this makes up a small percentage of my portfolio. Instead of me holding bonds, because we know bonds aren't very good, right? These guys have a better recovery rate than bonds, high yield bonds. So this fund holds about 49%, 50% in triple Bs. It holds about 40% in double Bs. And then it holds the rest in cash, just in case there's an opportunity to buy something else. Their expense ratio is about 0.5%. Very good compared to other funds. Extremely well. But they're not using leverage, and that's a good thing. Makes it easier to sleep at night. You can see who they actually hold in the top 10 holdings. And some of these players, like Octagon, are big. Oak Hill Advisors. Somebody actually said something about Oak Hill earlier today. So there you go. These guys are playing with the big boys, and they're giving you an opportunity. Current SEC yield is about 9.1%. How is their quarterly returns? According to their website, not bad. They're almost keeping up with the mezzanine index, and you can see since inception they're running about 14.25 on the NAV, but market is 13.98. So they're slightly below the NAV, which is good because that tells me you're buying it at a discount. Distributions have been very consistent once it got started. The first distribution was kind of poor, but after that, the distributions have settled out. The fund has settled out. The price of the fund has become very steady and consistent over time. And that's a good sign, especially if you want to sleep good at night. One thing about their distributions, they have all been ordinary income, just in case you're wondering. So these wouldn't be very tax efficient for somebody holding them in a taxable account. So Brad, we know you did your testing. How did it test? Well, let's bring it up. Look at that. Very consistent. Taking my 8%, and that's 8% of my original investment. So if I invested $50,000, I want $333.33 a month. That's what I want. So the blue line is representative if I reinvest everything. The red line is if I took my 8%, what's left over. And the green line is hey, I took it all. I'm going to take every single penny. I need to live on every single penny. And you can see the green line goes up and to the right slowly over time. The blue line goes up significantly, but that's reinvesting everything. And that's buying the market on the day that you get paid. I also want you to know that, hey, I left a link down below to CLO for Dummies from Steven, so you can go take a quick refresher. If you don't know about CLOs, you can read his blog. I'm going to continue to do videos on them, and I'm getting a lot more comfortable talking about them. I knew them, I understood them, but it's a whole different story when you're looking at that camera and nobody's looking back at you and you're just talking to yourself in a closet. That brings me to the end of this video. Hopefully you got something out of this. CLOZ may find its way into my portfolio as a safe hedge for the future, because I think equities are a little bit overpriced and they're going to run. And hey, you know what? Why am I going to be buying at the top of the market? Everything's going up, and that's a good sign. So until next time, God bless. So how's their total returns? According to their website. So how's their quarter